In March 2020, the stock market crashed so hard, America triggered something called a circuit breaker, which is basically Wall Street's version of everybody calm down. People were panic selling. Retirement accounts were collapsing. Millions thought the economy was over. And meanwhile, some wealthy investors were buying stocks faster than ever. But one billionaire reportedly made over $10 billion during the recovery. Not because he predicted the crash perfectly, but because he understood something most investors never do. When you panic, they go shopping. And the weird part? History says they're usually right. So first, let's destroy one illusion immediately. The stock market crashing is not rare. It's normal. Since 1950, the S&P 500 has dropped at least 10% over 50 different times. That's basically once every 1 to 2 years.
And yet, every single time it happens, people act like capitalism just exploded. But here's the crazy statistic. Despite all those crashes, wars, recessions, inflation, pandemics, the S&P 500 still returned roughly 10% annually on average over the long term. Meaning the people who stayed invested through chaos historically got rewarded. This next statistic is honestly disgusting. Missing just the 10 best market days over a 20-year period can cut your total returns almost in half. And you know when most of those best days happen? Right after crashes. Like literally during peak fear. When headlines are screaming, when Twitter economists suddenly appear, when your uncle says, "I'm pulling everything out." That's when markets often rebound the hardest, which creates this brutal psychological trap. People sell because they're scared, but the recovery happens before they feel emotionally safe again. Rich investors don't necessarily have better emotions. They just built better systems. According to studies from firms like Dowbar, the average investor consistently underperforms the market.
Not because markets are impossible, but because people keep panic buying and panic selling. The average person treats investing like a stress reaction. Wealthy investors treat it like asset acquisition. That's a huge mindset difference. For example, Warren Buffett became dramatically wealthier during periods when other people were terrified. In 2008, while banks were collapsing, Buffett invested billions into companies everyone else was running from. And years later, those investments became insanely profitable. I actually don't think market crashes are mainly about money. I think they expose people's relationship with uncertainty. Because when your portfolio drops 30%, your brain starts asking existential questions. Am I stupid? Should I sell? What if this gets worse? Why did I listen to finance YouTubers with LED lights? And suddenly investing stops being numbers. It becomes identity. Here's the statistic that completely changed how I think about crashes.
Every major stock market crash in U.S. history eventually recovered. The Great Depression, 2008, COVID crash, dot-com crash, every single one. Now, obviously, that doesn't mean every company survives. Some absolutely die. But broad markets historically recover because economies continue innovating. Businesses adapt. Technology evolves. Humans keep building things. And wealthy investors bet on that long-term human progress. New investors think rich people love crashes because they enjoy risk. Not really. Rich investors love crashes because they prepared before the crash happened. They keep cash reserves. They diversify. They think long-term. So when panic arrives,
They're not forced to sell. And that's the real power. Not predicting chaos, being able to survive it. I think this is the uncomfortable truth about investing. The market rewards people who can emotionally tolerate uncertainty. And that's hard, because humans are wired to run from danger. But markets have this weird habit of rewarding people who stay rational while everyone else spirals. So when rich investors see crashes, they don't just see fear. They see discounted ownership in the future. And maybe that's the real difference. Average investors ask, how do I avoid volatility? Wealthy investors ask, how do I survive it long enough to benefit from it?